Welcome to the Journey to True Wealth, and Happy New Year. I'm Steve Martin, Managing Partner and Senior Wealth Advisor here at SRQ Wealth in sunny Sarasota. Today's video is just a bit different from the previous ones and just a bit longer. I've titled it, Expect the Unexpected. Typically, I share a short educational piece to help you find your freedom. But since it's the beginning of a new year, I thought I'd shed some light on all the predictions that are being tossed around and give you some real-world common sense in its place. Before I share our thoughts on 2023, I thought I'd review a few insights that I've received from outside research. I've probably received 10, maybe 20 articles with predictions for 2023 already, but I found one that I think encapsulates all the rest. Check out Blackstone's 10 Surprises for 2023, in its 38th edition nonetheless. Now understand, this isn't coming from just any firm, it's coming from Blackstone, one of the largest private equity firms in the world. And it's not just their insights. As the beginning of the article states, we gauge the consensus of some of the world's smartest investors. Clearly, a lot of time and energy has been put into this. Now, maybe you're thinking, finally, a well thought out set of ideas from some of the sharpest minds. You might want to hang on to that thought for just a minute. Blackstone's kind enough that prior to giving us their expectations, they gave us a report card for how they did in 2022. Shall we take a look? Their number one prediction for 2022 was they expected that the market would be volatile and have a 0% return. Well, given that the market was down 27% at one point and ended the year down close to 20%, I'm going to have to give that one an X. And they said inflation was not transitory, but it would increase to 4.5%. I guess they got that half right. Inflation rose to almost 9% for the summer and the fall. And for a miss that large, I'm going to give them another X. I think your grocery bill would agree. Now for number 3, they guessed that the 10-year Treasury would rise from 1.5% to 2.75%. Again, that's a heartwarming guess, but it's only half right. The 10-year Treasury rose to a little over 4%. Now, when I was in grade school, and I only got 50% right, my teacher gave me an F. So I'm going to give them another X. Now I'm not going to bore you with numbers 4 through 10, but I think you can see where this is going. They actually did a little better. They actually got 5 out of 10 right. 50% right, coming from a collection of some of the sharpest minds. Interesting. Now they want us to follow their predictions for 2023, but I think not. We've got better uses of our time here. And as you know, the chaos continued in 2022. The central drama of the year, and probably this year, is the Fed Reserve's aggressive efforts to bring inflation under control. In 2022, the Fed raised rates 7 times for a total of 4.25%, and we likely got more to go in 2023. But consider this, after nearly 13 years from 2008 to 2021, the market went up close to 700%, but this past year it gave back 20% of that. And if anything, it reminds me of a phrase my grandmother used to say. Don't just do something, stand there. Now, standing there with your investments ended up being a far better strategy than getting out when the news was the worst in early 2020, or investing heavily at the end of 2022 after 2 great performance years. But the burning question of the hour seems to be to what extent the Fed might tip the economy into a recession, if it already hasn't done so. Now, over the coming year, the way this plays out will likely drive stock prices. But our position continues to be that this outcome is simply unknowable. That said, I believe strongly that we got to do whatever it takes to beat inflation. So for 2023, expect the unexpected. And just when you think we'll have a recession, we likely won't. And if we do, it will have happened several months ago. And there's nothing you can do about it now. And just when you think it's time to sell, it's probably time to buy. History tells us that's almost always the case. And when you think your income is fine, remember that in 30 years, with only 3% inflation, you'll need 250% more income just to buy the things that you're buying now. Statistically speaking, markets do tend to go up after bear markets, sometimes substantially. And they also tend to do better in the third year of a presidential cycle. And while I'm glad these statistics are in our favor, they are just statistics. But for these reasons, we are very excited about 2023. I personally feel good times are just around the corner. Heck, we build rockets that return to Earth just to be used again. And we can have virtually anything at our doorstep in 2 days. And did I mention air fryers? Come on. Now, while I'm optimistic, we may have some messy times getting there. And even if we do, the following upside will likely be even greater. But don't focus on these things that are out of your control. Instead, expect the unexpected. Now, for our recommendations, for one, focus on your plan and how you'll weather the rest of this storm. And have a big bucket of cash for the short term. And also have a big bucket of stocks for the long term. And most importantly, realize that when, not if, the Dow Jones Index hits 50, 60, 70,000, it won't matter where the market ends this year. That's the best advice I can give you. So, thank you to all of our clients that are part of the SRQ Wealth family. We really appreciate you. And if someone comes to mind that needs to hear this, please forward it to them. We would really appreciate that. But if you're not part of the SRQ family, click the button to my right and learn more. It's just a cup of coffee. No pressure, no cost, no commitment. As always, thank you for your time, and God bless.